Hi everybody, today I'm going to be doing a presentation on chapter 18. This is the guest lecture presentation number 3 and it focuses on pages 494 to 491. So today's presentation would be broken down into two different parts. The first part is going to be the case application. As an example, we have the Centralia Corporation and we have a few topics or a few tools we're going to be talking about the after-tax operation cash flow, the depreciation tax shields, these concessionary loan payments, and insurance tax shields. In part 2, we're going to be talking about the real options, what is the APV, and what is positive versus negative APV. And we're going to also talk about a few examples of a certain future due to government changes. Part 1, Case Application, the Centralia Corporation, pages 495. So the book talks about the Centralia Corporation as an example for today's topic, and they're giving us an example that the Centralia Corporation is a Midwest manufacturer of small appliances such as microwaves, and they have a current market in Spain, which obviously is a small market, and they're unable to expand to other European countries because they have different electrical standards or they require different electrical converters. But now they're looking to the possibility of expanding to other European Union countries due to the recent removal of obstacles of free movement, such as goods, services, people, and capital. Now, the marketing production managers are looking to see if they have a great potential and if they decide to explore new territories. So to do this, they kind of need a few tools before they make the final decision. And these tools we're going to be talking about them next. How can marketing and production managers make decisions? What are a few tools that they need in order to make decisions? Because they cannot just say, um, let's go ahead and jump into this market or into that market without having a previous knowledge of what the market looks like. So these are a few tools. So one of the things that they would need to do is to check the after-tax operation cash flow. They would need to calculate it. And what is the after-tax operation cash flow? So it is this measures the performance over time and the corporate components. See how the company does compared to the other companies. This measures the financial performance that shows the ability to generate cash flows through operations and is calculated by adding non-cash charges back into the net income. One of the examples would be depreciation or depreciation expenses. So another thing that a company might need to do or we need to do is calculate the depreciation tax shields. And depreciation tax shields are expenses that need to be subtracted from taxable income. These amounts shield the taxpayers from income taxes. This is most effective in asset-intensive industries because you have a large amount of fixed assets. So here we have two examples of depreciation. The most common, the one that was used here in the example in the book, it's the straight line depreciation, which means that the asset will be depreciated equally throughout the years, whereas units of production is a non-common um, production depreciation type of calculation, which bases themselves on how much they produce each year. Granted, not all the companies produce the same amount of years because they don't need to sell or they might not produce as much, and this is kind of not accurate. But the way to go is straight line depreciation. So another thing that they would need to calculate or they would need to look into would be the concessionary loan payments. Obviously, if you're gonna move your operations, you also need somewhere to borrow money from, and concessionary loan payments, or I mean, concessionary loans, are much more attractive because these are more generous loans due to the terms incorporated to the market loans. They're below market interest rates, and they have grace periods where the recipient is not required to make payments for several years. So grace periods would be periods where the person or the interestee will only have to pay interest and services fees and not the principal. Um, some of the people or companies might be attracted to both sides because they have good interest rates and because of the grace periods. And these loans are created by the affiliates of the World Bank to entities unable to borrow at market rates. So if you have here, look at the chart, we see an example of a payment should you borrow. Let's say, I don't know if you have taken any other class, but we all know that when you have different payments on a loan, we know that the first payments we tend to pay more interest rather than the principal. And as we start moving year by year, we're gonna be paying more principal rather than interest. So by the last payment, everything that we do is we pay pretty much the principal of the loan and a little bit of the interests. And a lot of loaners, what they do is the way that they do this is because they obviously if you borrow money to somebody else, you want to make your money back as soon as possible. So rather they go like, hey, instead of you paying me back the principal, I want you to start paying me the interests first rather than what I borrowed you. So another thing or another tool that we need to calculate would be the interest tax shields. And this is the reduction of the taxable income, which is the protection of the taxpayer's income from taxation. This allows the payer to claim deductions on things such as mortgage interest, medical expenses, charitable donations, amortization, and depreciation, and so on. Now that the company has made or has found all of these tools, they have calculated everything that they need to do, and now they need to sit down and they need to make a better decision. And this takes us to our next point. So our next points would be in part 2, which is real options and can be found in page 490. APV or adjusted present value. The APV is used to calculate the capital expenditures, exchange rates. The APV treats risks through the discount rate. So if we have a positive APV, then we would say that the project is accepted, assuming that the decisions will be favorable to the company. If a negative APV is found, then the project would obviously be rejected. The decision can be adjusted upon more information such as alternative paths or options, depending on how the economy on the country that we're trying to expand starts changing, new sanctions or perhaps new opportunities. So it would all depend on this as well. And real options are use of options of pricing theory to evaluate investments options in real projects such as expanding or a change of curtail projects based on certain projects based on the charge of the economy, based on technology or market conditions, etc. So what are some of the real options? So some of the possible options might include the timing option. When should we make the investment? The growth option. Are we capable of increasing the scale of our investments? The suspension option. Should we temporarily cease production? And also the abandonment option. Should we quit our investments early? So obviously with everything or any type of investment, we run into uncertain future risks due to the government changes. Some of the risks might be the multinational corporations face a political uncertainty because they have changes in political parties that may turn unfavorable for corporation. Let's say that you're thinking that an example out there, let's make cars to be red, and then that's our motto. We make red cars. Later on, the government says, hey, we have too many cars out on the road. Let's make that illegal. And because of your corporation being 100%, based on the color red, now you see a big issue because now you cannot produce any more of these cars. And the same goes for the company that we were talking about in the beginning, because again, you were making microwave, so they were making microwave with a certain type of adapter, and they couldn't expand. And this is the contrary. They couldn't expand because of that, the lack of the power adapter. But because the governments or the European countries said, okay, let's drop that because like it doesn't seem you know a very unique situation. So what they're doing is say, hey, now you can start coming in to sell your products. So now it gives them more favorable options for the company. But I mean, later on, if they're producing, they can say, hey, we no longer need this anymore, or we no longer need microwaves, or any other reason. And for instance, we have an example right now of the Ukraine and Russian situation that we're currently having. Let's say that you had plans on opening a company in Russia, or many companies for that matter, and this was like 5 years ago or 4 years ago. You didn't know the future today, and now you would have faced a lot of sanctions with the SWIFTs that banks are not allowed to communicate with Russian banks, so you would be facing a lot of losses right now. So summary, to make a decision, we need a few tools, which are after-tax cash flows, which is how good are we generating cash flow through its operations. We also need to calculate the depreciation tax shields, see how much my assets are depreciating each year, and how can I subtract them for my taxable incomes. Another thing we need to calculate would be the concessionary loan payments. So where can I get a decent payment? I mean, a different loan to make certain payments. And we also need to calculate interest tax shields. What claims can we make before submitting our taxes? And this is the example that we talked before with the company of the electronics that wanted to expand over to other European countries, where like they need to see how good they're doing right now compared to other markets. They also need to see the markets, how they're doing in other European countries. Is there a market for them? Can they sell microwaves, or can they sell something else perhaps? So these are decisions that the company needs to make before taking the final decision, and they need to face real options. Which real options they will need to focus on I need to adjust the present value, and they also take into consideration the uncertain future due to government changes. We said we have government parties winning over others, and of course there are new laws and regulations preventing growth to the company. So these are some of these um, examples that I can give you right now. Thank you everybody for taking your time to listen to my third presentation. I hope you understand these topics are a bit more complicated than I made it seem. We need more examples, of course, when it comes to calculating certain types of taxation, depreciation, but I gave you the basics, so hopefully it was understandable. If you need more details, you can look at these resources, which I really found helpful. Thank you.